Hello everybody. So now that Bitcoin has grown so much, Bitcoin's expensive, it's time to go back to what this channel, started with and still talks about frequently, which is inexpensive stocks. And today's video. In today's video, I want to focus on a sector that I have consistently found cheap, probably because it's dismissed by traditional healthcare, probably because it's dismissed by pharmacy chains, the CVS of the world, probably because it's dismissed by the insurance system, and that is the direct-to-consumer health world. And these startups that are now bigger and that are growing quite fast in that sector and that are still dirt cheap when you adjust for growth. So the goal of this video is to go over an update on the valuation, and I will mostly talk about LifeMD, HIMS, and Talkspace, but I'll also briefly talk about GoodRX, Teladoc, and Well.to, which is a Canadian company. So let me get started. Let's start with LifeMD. So LifeMD is the cheapest stock in this sector. It is also consistently one of the cheapest, if not the cheapest stock out of more than 200 stocks that I have in the spreadsheet. Why is it so cheap? Well, if you look at the number of EBITDA margin is 12%, so that's good, and that's growing, and that's now growing quite fast. They're also growing revenue very fast at 29%. And how much am I paying for that growth? I'm paying a 0.046. So this stock is dirt cheap. This stock is as cheap as HIMS once was. So it's still cheap. It's still very cheap. LifeMD is a confusing stock, and you may be confused if you would look at my spreadsheet, because you can see I have LifeMD, the full company, with 193 million in revenue, trailing 12 months, predicted to go at 29%, and I value it at a 0.04, and then I have LifeMD without WorkSimpli. And I'm assuming that they sell WorkSimpli for $70 million. And so if I remove, and WorkSimpli, by the way, it's a software that has nothing to do with LifeMD. It's, that company did a pivot into healthcare, and they were into software before. And so they have a major stake in this WorkSimpli, which is a SaaS business. It's a tiny SaaS business with flat revenue growth, but profitable business. If I remove WorkSimpli, this is roughly the calculation that I get for LifeMD, assuming they sell WorkSimpli for $70 million. If you listen to the conference call of LifeMD, the top management team keeps trying to sell WorkSimpli because WorkSimpli is confusing the stock investor. But if you remove WorkSimpli, you can see that actually the growth rate of LifeMD, and this is not a mistake, is 53%. I say it's not a mistake because HIMS is predicted to grow at 53% as well. So this company is growing, per my calculation, at the same speed as HIMS if you remove LifeMD. The reason why the revenue growth only looks like 29% is because they have a flattish software business attached to it. And if I assume they sell it for $70 million, and I assume then the new growth rate, then my enterprise value over gross profit over revenue growth, it's a 0.02. And my rule of 40 jumps to a 65. So without WorkSimpli, LifeMD looks even cheaper than itself today, and it looks, of course, even cheaper than HIMS, and 5 times cheaper than HIMS. It goes from roughly 3 times cheaper than HIMS to about 5 times cheaper than HIMS, and it's got a similar rule of 40. And if you are on Patreon, if you get my buys, my portfolio moves, you may see that I've added LifeMD quite a bit lately. Why is that? Well, it's because the valuation, and I like low valuation and high growth. Growth snob on one hand, and then I want low valuation, and I also want a rule of 40. I want it all. So LifeMD fits the bill. No, the thing that really makes me love LifeMD recently is the fact that, yes, they have just launched their own remote pharmacy. They're finally getting it. They're getting the fact that really, once you're a doctor, if you prescribe something, and if you send people to Walgreens or CVS, you're leaving money on the table, right? The doctor should prescribe, but should also be a pharmacy and fulfill. Prescribe and fulfill. That is the HIMS strategy, and they are following that same strategy now, even though they started as a doctor-only business. LifeMD, what is LifeMD? LifeMD is kind of a Netflix for doctor visits. It's a subscription for doctors. That's all it is. So for $39 a month, which is their total care, which is what they're trying to sell the most here. $39 a month, you get up to one doctor visit a month. And if you don't want to do a subscription, they also will take your business gladly, and it's $139 for a visit with a doctor at LifeMD, and then you can discuss your issues, and then whatever you discuss with the doctor, stays with the doctor. It's still traditional medicine, but it's done fully online. LifeMD has a very interesting work culture in New York City. They are 50 doctors that all work in one spot, and all of the doctors are located there. So kind of less of a platform, more of a doctor's office, but that is fully remote and fully digital. And you can see they have a GLP-1 program for $149. So this company is also getting some business from the GLP-1. They even have for people who need more medical care, $99 a month, unlimited free visits. Well, not free, you pay, right? But that's why I say this subscription to doctors, I call it's ideal for the medium health stuff, right? So for example, diabetes, that would be no medical advice, no financial advice, the gist. But for example, like a more medium health issue, that would be who they cater to. And HIMS is more really entry-level health issue. One thing that they have that HIMS doesn't do, but I anticipate HIMS will do that at some point, is they're partner with Quest for diagnostics and labs. And you may know, because they do primary care is one of their big business. A big part of primary care is getting your labs done, and so they do the labs. And so they're partner with a Uber-style phlebotomist, Adam phlebotomist, where the phlebotomist will just drive to your house and collect the sample, and it's $39 plus the fees on top of that for the lab. So they'll just send a phlebotomist Adam to collect the blood sample. That's how they do it. And like I said, they still have coupons, but they just launched their own remote pharmacy. And of course, the coupon for prescriptions, that is the main business of GoodRX, right? So LifeMD, by issuing coupons, is kind of competing against GoodRX. GoodRX is getting some competition right there. So that's LifeMD. I find it dirt cheap. I think they have a very interesting offering. I think they're slightly differentiated from HIMS in the sense that they can address concerns that are a little more complex, but there is definitely some overlap with HIMS, but they can address stuff that are a little more complex. So that's why I call them like a medium stuff type company, medium health issue, and it's all fully remote. And frankly, the growth is great. It's doing great. So I own LifeMD. I've been adding a lot to it recently. I haven't been adding to HIMS recently. The last time I bought HIMS was when it dropped at 19 on a fear about a month ago now. So, but at 34, I'm not adding to HIMS. If HIMS drops back now, maybe under 22, maybe I'll add. Let's talk about HIMS. So let's move on. Let's talk about HIMS. So HIMS is my number 3 position in my portfolio. It's a channel favorite. It's one of my favorite. It's now a 6-bagger for me, and I know there's 12 baggers in this little YouTube channel of mine and this little community of mine on YouTube. I know there are some people who are close to a 12-bagger on him. So got it in the $3 range. My average is in the 6-ish on this stock. I've covered it ad nauseum, and so if you follow my channel and you're not interested in HIMS, I guess I apologize. But yeah, that's because for the longest time this stock is cheap, and this stock is extremely volatile. Right? It's not MicroStrategy volatile, but it's super volatile. Like it's a ping pong. It's being bounced around. Whenever there's a negative piece of news, Amazon enters the field of healthcare about twice a year. Whenever Amazon rebrands their healthcare initiative, HIMS will drop 30%, right? That's kind of how it works. And so expect 2 big drops in 2025 whenever Amazon launches the nth health initiative. And of course, the market I think still largely misunderstands the business model of HIMS. HIMS is not a low-cost provider. HIMS is a best-cost provider, and there's a nuance, there's an important distinction in the disruption that they do. It's not just about getting the cheapest cost, it's about knowing how much things cost, which is addressing one of the main issues in healthcare, which is you drive up to a clinic, you want to try to find out how much it's going to cost you to get something addressed, some health issue addressed. Good luck. Like, healthcare is still the only system where you kind of enter into a contract when you go see a doctor and you get the bill 6 weeks later. This is not how it works for HIMS. They address this business model. The way I describe HIMS is through this funny equation. It's an e-doctor, electronic doctor, digital doctor, and an e-pharmacy put together without insurance. There is no insurance for HIMS or for LifeMD. They do not take it. There's no insurance. And with having no insurance, that means you can do it cheap, because you don't have to jump through the different hoops that each insurance has put in place with the explicit, it's not explicit, it's a joke, it's implicit, with the implicit intention of making it very hard for your doctor to get reimbursed, right? That's, if you're a doctor, you know this is an ongoing thing of Medicare and insurance and payers. They always try to pay you less, and managing that complexity has a lot to do in how successful you are as a doctor. HIMS does entirely away that complexity. It's simple. They don't take insurance. They don't accept insurance. That's a business model innovation. A lot of traditional finance sees this as a negative. A lot of people who are, in my view, think for themselves, see that it's actually a positive, because what that means is that HIMS is able to move so fast. They're able to move so fast. So what do? Business model innovation. They've created this brand from scratch where the cost of the doctor visit is wrapped into the prescription drug. The monthly cost of your prescription drug includes that doctor visit, and includes the follow-ups. It includes the doctor visits. I also want to say, whether it's HIMS or it's Talkspace, we'll get to Talkspace in a second, they enable things like chatting with a doctor on a chat box, which, if you look at any survey from Gen Z, from younger millennials, the last thing they want to do is talk to someone on the phone or on a video call. They wanted to have a chat box. And so they enable that type of visit, which is just by chat, right? Which is much more in line with the younger culture, with the youth culture, which is also the same target population, which is likely to not have insurance, right? A lot of people want to be freelancers. They have a Uber driving thing, and they have a side gig. So it's a gig economy, right? And so they see a lot of value. This Gen Z, in my view, sees a lot of value on this on-demand health that is specifically designed for them. And they see little value in getting health insurance, because let's face it, if you get health insurance throughout your 20s, your 30s, even until your late 40s, most of that health insurance premium is gonna go to give equilibrium to the system. Right, that's the point of this. It's like they hope everybody gets it, because you got to get a bunch of young people to pay for that $600 a month health insurance premium to sponsor the older people who are on their insurance plan, right? So a lot of people are seeing less and less value, and they don't have any problem paying out of pocket. And another part of a business model innovation, which you don't have in traditional legacy healthcare, is that HIMS will not charge the patient if the patient doesn't qualify for the drug. The doctor is sovereign. The doctor puts their liability out there. And so if a doctor sees someone coming, I don't know, say for an ED drugs or an ED pill or something, and the person coming in, I'm not a urologist, I'm not a specialist, but let's say there's a health issue, there's a contraindication to that medication. The doctor is not going to prescribe it. So if the doctor denies it, then guess what? It's free. You don't have to pay. The doctor denies it. Andrew Durham talks about that on the call too. They also have partnerships with health systems. And so if HIMS cannot handle what you ask, they will point you out to a local clinic or local hospital. So they refer you. They refer you for free. They deny you for free. This is not something that you have in the analog face-to-face world. In the analog face-to-face world, if the doctor tells you no, the doctor tells you no, right? And you still have to pay $200 or something for that doctor visit. And they are adopting traditional business sense and applying it to healthcare. And by that I mean it's soon to be a vertically integrated company. I still have to make that video about HIMS becoming a vertically integrated healthcare company, because if they provide the doctors, they provide the prescriptions, right? So that typically was the clinic to do that. Then they provide the meds, they provide the pharmacy, they provide the compounding, right? That's typically something that was done by a business. And then they provide what? They provide the brand. They're introducing branding. This is something that was done by pharma companies, right? For example, one of their hit products is called Hard Mints by Mints. Hard Mints by HIMS. That's the name of a product, and it just looks like a breath freshener, like a pill for your breath, and it's how we call it, a hard mint. But guess what? It's sildenafil. Sildenafil is generic for Viagra, right? But they've branded it in such a way that people don't feel bad. People don't feel sick. You don't feel as sick. You don't say, "Oh, I have to be on sildenafil because I have this issue." You're like, "No, I'm having a hard mint." So this is the original playbook of Amazon and customer satisfaction and making the customer feel good, not making the customer feel bad. These brands are very approachable. And so, you could be a cynic and you could say, "Oh, the danger is that people are going to pop it like candy. And so, therefore, we have to make the customer feel bad and feel sick." That's the cynic, I would argue, would say that. I would argue the more positive way to think about this is that if you make the drug branded, if you make your customer feel good, you're going to have much better patient adherence. The patient has to use the drug. If the patient doesn't use the drug, whatever issue they're trying to address, they're not going to get cured with it, right? And so promoting patient adherence comes with making the patient feel good. And sure enough, this is something that traditional healthcare hasn't done. And lastly, branding medication, that's big pharma, right? Pharmacy, that's your CVS of the world. The doctor network, that's the clinics, that's the local health system. And now they're doing the generics too. They're going to launch their own GLP-1, their once daily liraglutide for weight loss. They're going to launch that. They bought a company in California to manufacture their own. So they're gonna make generics too. So essentially, what I mean by vertically integrated is you're looking at a company that is slowly becoming a 4-in-1. And so that vertical integration allows them to have that low cost. So I've covered this multiple times on this channel. Hopefully you find it interesting. But this is a stock that I plan on owning for the next 10 years and, of course, monitoring it. But to me, this business is going to be amazing. Oh, and of course, for LifeMD or HIMS, I didn't even talk about the GLP-1 opportunity, which is another big opportunity of these stocks. Let me move on now to Talkspace. So Talkspace is my smallest position out of the three. I own LifeMD, HIMS, and Talkspace. So that out of the 6 stocks that I talk about today, these 3 I own. Talkspace, now you're going to tell me, well, that's weird. You own Talkspace. Talkspace mostly deals with insurance. Mostly deals with insurance companies. Well, yes. And originally that is a problem, and that was a problem, and so before I started studying this company, that was always a problem for me. And you may even remember the first time I talked about Talkspace, I was like, oh, I actually like Teladoc's BetterHelp business better. Well, that was before I discovered about generative AI. I now happen to think that the only way to build a company in the sector of mental health is by actually taking the governments, the cities, the insurance companies at their word. And why do I say at their word? If you follow American culture, if you follow health trends for the past 10 years, you know that everybody talks about mental health. It is so pervasive. Everybody talks about mental health. How many employers in their EAP programs have implemented mental health? Everybody talks about mental health. It seems to be the big trend of the past 10 years. And so governments, cities, high school, and insurance companies seem to be saying that they'll pay for it. And so Talkspace has spent a few years designing a website, a platform that allows them to collect these insurance premiums, And so they have so many covered lives, over 100 million covered lives. I think it's close to 200 million covered lives that they have now. People who have some mental health benefits via their insurance. And what Talkspace does is it jumped through the hoops of each payer and tried to get the maximum reimbursement they can from each payer. And so this is really a question of taking the insurance companies, taking the governments at their word, and seeing actually they will pay up. And so if they will pay up, I could be a cynic myself and say they're gonna run those governments dry. It's kind of a cynic. The cynic in me is going to say that because look at that, Medicare covered by Medicare. So if you listen to the call, they explain how they have big hopes for enormous demand coming from Medicare coverage, because in the 65 plus community, there is a loneliness epidemic. And so they're thinking that Medicare is probably going to pay for a whole bunch of sessions with therapists for over 65 plus via Medicare. And so, of course, with Medicare, the risk is that, every year they can change the coverage. So that's a risk. And insurance companies, of course, are also quick to change the coverage whenever they see too much money. So hopefully they can stay stealth and not take on too much money. But nonetheless, they're making that gamble. And so they're making that gamble on Medicare coverage, paying for mental health, particularly to help the loneliness epidemic. They're taking that bet with Department of Mental Hygiene. I don't know if you knew that was a thing, but there's many cities have renamed their Department of Health. They've renamed it Department of Health and Mental Hygiene is how they call it. And so they make it an explicit goal to offer mental health services. In the case of cities, mostly for teenagers. So you have a lot of high school programs, and they'll pay a bunch of money to Talkspace to provide mental health services to the teenagers. And you also have the historic business, which I would put the historic business for Talkspace and for any company in that field. And this is, by the way, business that I don't think is ever going away. It's veterans, big business, and couples counseling. So I don't think this is what I would call the historic patients, and I don't think that's going away. I don't necessarily think that's either something too big of a growth space, but what's definitely a growth space for Talkspace is definitely the loneliness epidemic with Medicare coverage now for the 65 plus and teenager mental health issues with high school programs, and getting the cities and getting the school districts to pay for these high school programs. I think if digital mental health is going to be a thing, in my view, that's going to be the only way that you can do it, because researching this, I see it more and more. People who don't have insurance cover real humans. They'll just use generative AI. I think they'll just use Gen AI, and it's already a major trend in that space. If you research it, of people asking ChatGPT, you are now a therapist for this. You're now an expert couples counselor, ChatGPT, and you have 25 years of experience, and you're especially good at dealing with people who want to get a divorce. ChatGPT, can you be that specialist couples counselor for me and my wife? Can you do that, ChatGPT? ChatGPT is like, sure. And then you'll have a conversation with ChatGPT. So generative AI, I believe, is a threat to people who are going to be paying out of pocket for these services. But if you're not paying out of pocket for the services, if Medicare is paying for it, if your high school is paying for it, then generative AI is less of a threat, isn't it? So that's kind of my play. That's kind of my take. Answering the question, how cheap is it? It's not as cheap as LifeMD. It's not as cheap as HIMS. But if you are a believer that mental health is a major issue and that there's going to be a major need for that business, which based on my research seems to be what everybody believes, it seems to be the case that there's going to be a major need for mental health, then I would argue this is an inexpensive platform, an inexpensive stock, right? Trading at 2x times, right? So, anyways, we'll see how it goes. It's a starter position for me, but I put my money where my mouth is, so I own it too. Let me conclude this video by telling you about the 3 names that I am not in. So GoodRX, GoodRX, I would argue, I would argue GoodRX is responsible for a lot of the woes that, well, no, I'm not going to argue that, but I'm just saying GoodRX is a coupon for pharmaceuticals, right? So it's a coupon for pharmaceuticals, and what doctors do often is they'll if patients are concerned about the cost of medication, the doctor pulls up the phone and it's like, do you have the GoodRX app on your phone? Oh, look, and then they type the name of medication, showing to the patient, and then the patient is like, wow, what do you mean 97% off with GoodRX? My insurance, it's this cost, so it costs less with GoodRX, and then GoodRX redirects the customer, the patient, redirects the patient to the cheapest pharmacy in their area, the cheapest pharmacy in their town, which oftentimes is not a CVS or oftentimes is not a Walgreens. Oftentimes it's a pharmacy in a grocery store. So it's a coupons business. That's what it is. GoodRX is a coupons business. And they've been quite successful. It's because it's a coupons business. You can see the margin it's pure. It's as pure as it gets with that margin, 93% gross margin. It's very few business get above the 90%. It's close to a royalty business, which is essentially what it is because they don't fulfill any of the orders. They don't do any of that. It's just an app. So talk about transforming an idea into a business. Very powerful stuff, if you ask me. But I think GoodRX has seen some of the limits of the business model, which is why A, it's not growing very fast, only predicted to grow 3%. So you're growing way slower than inflation. And then B, they got into the online prescriptions. So they got into the game of being a platform and trying to get people not only the coupon, we not only get you the coupon for the drug, but we also get you in front of a doctor to get you that prescription. So they are in many ways adopting the playbook of LifeMD, the playbook of HIMS, trying to disrupt your brick and mortar doctor's office that has been in the town for 30 years. And so, interesting way to revive growth. I am not into this company, into this stock. Now, let's talk about Teladoc. When I started the channel and I started explaining why I don't like Teladoc, I cannot tell you how many bad comments I would get in the comment section. Not too many because the channel was not that popular, but 2022, 2021, everybody was pro Teladoc, and Teladoc was a Cathie Wood's favorite. And of course, Teladoc did not do so well. The growth stalled because Teladoc, in my view, they can't move very fast because they are operating with insurance. They accept insurance. You access Teladoc via your insurance system. And so it's just as complicated to go see a doctor via Teladoc as it is to go see a doctor with your local doctor's office down the street. And by complicated, I mean there's a general lack of transparency. Again, this is just my opinion, nothing more. But there's a general lack of transparency, which is why, in my view, they don't have a clear pricing. It's just not very clear. It's not very clear how you use Teladoc. And as a result of that, the growth is not very good. And in addition to that, because they work with insurance companies, they are subjected with the same issues that a regular doctor's office is subjected to. If you look at a regular clinic, a regular doctor's office, they are just being, hurt by insurance companies, hurt by Medicare. Whenever Medicare changes a reimbursement rule, the local doctor office down the street is hurt. But Teladoc is hurt too. because they operate within that insurance system. And so it's a very tough business to be in. And that's why I am not in Teladoc, and I'm not interested in owning the stock. The numbers don't look good, no matter how I put it, especially when you compare to some of the other numbers in the spreadsheet. Lastly, Well.to. So Well.to is a health tech in Canada. I had said I need to study it more. Unfortunately, I haven't had the time, so I can only tell you the numbers of Well.to, and it is cheap, but it's not as cheap as the US stocks. Unfortunately, it's not. I mean, it's more expensive than Talkspace. Then again, Canadian stocks are expensive. It's expensive relative to, say, a HIMS or Talkspace. It's cheap compared to the stocks in my spreadsheet. So compared to all of the stocks in my spreadsheet, which if you have it on the Patreon, you can see so many of them are on EV, enterprise value over gross profit over revenue growth. So many of the stocks in my spreadsheet are well above a 1. So 0.25, you're getting into you're roughly in the first quartile. So it's pretty cheap, and they almost have a rule of 40. So it's pretty cheap, but again, it's look at a LifeMD, look at a HIMS. These are purely digital businesses, and so they perform in my view in a better way. Well.to partners with a lot of offices, a lot of doctors' offices in Canada. They've entered in the US recently, so we'll see how that goes. If you know more about Well.to, don't hesitate to put it in the comments section. So hopefully this gives you a good overview of my thoughts on the direct-to-consumer health stocks. This was not financial advice, not investment advice, just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thanks for watching, and have a wonderful, wonderful day.